Mullen Automotive began trading post-split today, and the result was as brutal as it was predictable. After consolidating shares at a 1-for-100 ratio, the stock opened around $2.04, briefly climbed to $2.88, but then spiraled down to close at just $2.25, a near 40% collapse based on the split-adjusted price. It's the fifth reverse split the company has executed in under 3 years, and if anyone still needed a sign that investor confidence has all but evaporated, this was it. What makes this drop even more sobering is that it didn't happen in a red market. The broader market today? It was actually fairly steady. The S&P 500 moved modestly. The Nasdaq was slightly down, but nowhere near panic territory. So no, this wasn't a macro sell-off. This wasn't interest rate jitters or geopolitical headlines. This was a direct result of how the market views Mullen specifically, and that view isn't good. We're now in territory where even long-shot believers are starting to quietly exit. The stock, after 5 reverse splits and billions of shares issued over time, is giving less and less back to those who held through it all. The narrative has shifted from potential disruption in the EV market to a slow-motion case study in shareholder erosion. And while Mullen tried to soften the blow with its recent announcement about a partnership to produce semi-solid-state batteries with Empower Green Tech, with production slated to begin in 2026, the market's not buying it. The battery deal sounds impressive on the surface, but when you dig deeper, it has all the hallmarks of a familiar pattern: flashy PR during financial crisis. There's no immediate revenue. No hard delivery date. Just an agreement and a hope. It's hard not to feel for the people who have stuck around this long. The stock's fall from dollars to cents, and now back up to dollars only through accounting tricks, has been emotionally and financially exhausting. And now we find ourselves here, post-split, with another 40% haircut for shareholders who've already been sliced to the bone. Of course, Mullen supporters, and even the company itself, might point to the ongoing spoofing lawsuit as a possible turning point. The suit alleges that broker-dealers engaged in manipulative trading, including placing and cancelling massive sell orders to artificially suppress MULN's price between 2021 and 2023. And just recently, a judge allowed the case to proceed, denying the defendant's motion to dismiss. But if we're honest, that lawsuit, at this point, feels more like a moral victory than a financial one. It's the kind of thing you might call a source of pride if you're a long-suffering fan, like how English cricket supporters call a hard-fought draw at Lord's a win because of the spirit behind it. The reality is, even if the case succeeds in court, any monetary settlement is unlikely to repair the company's core problem, which is its deteriorating fundamentals, lack of meaningful revenue, and repeated shareholder dilution. This isn't to say that the lawsuit is meaningless. It's not. If Mullen was genuinely targeted by coordinated manipulation, that deserves to be exposed. But what's important to understand is this: a legal win won't suddenly make the balance sheet look better. It won't deliver vehicles. It won't bring back the 90% of shareholder value that's already been lost. It's not a business plan, it's a side story. And that's really where we are now. Mullen isn't being evaluated on its promises anymore. It's being evaluated on its track record. And so far, that track record includes 5 reverse splits, multiple SEC filings to raise even more capital, unfulfilled manufacturing claims, and a shrinking retail base that's increasingly frustrated and fatigued. The company's communication strategy seems focused on survival. And while survival is important, survival alone isn't value creation. Reverse splits might keep the Nasdaq listing alive, but they don't inspire new investment. They don't fix the fact that shareholders have been hammered into dust and that every bounce is met with more dilution. So, as the dust settles after today's 40% drop, the question isn't really whether MULN will bounce back. The real question is whether there's anything left to bounce. At some point, even the most faithful investors get tired of hope. And right now, MULN isn't trading on potential, it's trading on memory. On sentiment. On fumes. This isn't financial advice. But it is a moment to reflect. Because after 5 splits, 5 rounds of dilution, and a stock that still can't hold ground for more than a few hours, the silence from retail investors is getting louder. Thanks for listening. Let me know in the comments, were you watching MULN today? Did you expect this, or were you still holding out for a post-split pop? I'd love to hear your thoughts.